The most popular personal finance tip on the internet right now is to cut your daily coffee. Let that sink in for a moment. In an era of AI-generated equity returns and programmable money, the dominant financial advice is about a $5 beverage. Here's what that tells you about the quality of information in this space. The research on wealth accumulation is unambiguous. Savings rate and investment consistency explain over 80% of long-term net worth outcomes, according to a Vanguard longitudinal study. Spending optimization is a footnote, so the real question this video is going to answer is not where to cut. It is where to allocate, what rate to do it at, and how to build income streams that compound on each other so your financial position becomes structurally harder to reverse. Let's start with the one number that determines almost everything else in your financial life. Your savings rate, not your income, not your investment picks. Your savings rate, the percentage of gross income you consistently direct toward building assets. Here is why this matters more than any stock tip. At a 10% savings rate, reaching financial independence takes roughly 43 years, assuming a 5% real annual return. That is the standard American retirement timeline. Raise that rate to 25% and the timeline compresses to 32 years. At 40%, you are looking at roughly 22 years. Cross 50% and you drop below 17 years. These numbers come from the established compound growth models that have been validated across multiple economic cycles. The inflection point, where time compression becomes genuinely dramatic, sits around the 35% savings rate. Below that threshold, you are fighting time. Above it, time starts working disproportionately in your favor. Now, the immediate objection is obvious. 35% is not accessible to everyone. That is true and worth acknowledging. But for anyone earning at or above median household income, which in the United States currently sits at roughly $74,500, the path to 35% is primarily a structural problem, not an income problem. It requires designing your fixed costs to consume less than 50% of take-home pay, which is achievable, but only if you front-load those decisions before lifestyle inflation compounds them. The actionable move here is specific. Calculate your current savings rate this week using actual bank data, not estimates. Most people are off by 8 to 12 percentage points when they estimate. That gap is your baseline. Every intervention we discuss after this point only matters in the context of that number. The passive income conversation in this space is almost entirely wrong. Not because passive income is a myth, but because most people approach it as a collection of independent streams rather than a compounding architecture. The distinction matters enormously. A collection of income streams looks like this. You have a dividend portfolio generating $400 a month, a digital product on Gumroad bringing in $200, and some interest on a high-yield savings account. Each runs independently. The total is $600 a month. Fine. An architecture looks different. The dividend income reinvests automatically, increasing the dividend base. The Gumroad revenue gets allocated to a taxable brokerage account, which itself generates dividends that reinvest. The high-yield savings acts as your liquidity buffer, so you never have to liquidate equity positions at the wrong moment. Each element feeds the others. The compounding effect is not additive. It is multiplicative over time. According to a J.P. Morgan asset management analysis of wealth accumulation patterns, individuals who structure passive income to auto-deploy into other yield-generating assets accumulate net worth at approximately 2.3 times the rate of those who treat passive income as supplemental spending cash. Building this architecture requires three things: a dividend reinvestment plan turned on by default, a dedicated allocation rule for any non-W-2 income. We use a 70-30 split, 70% invested, 30% accessible, and a brokerage setup that makes friction work in your favor. Commission-free platforms like Moomoo or Robinhood remove the transactional barriers that used to cause people to delay reinvestment. The actionable move: Map your current income streams on paper and draw the arrows. Where does each dollar go when it arrives? If those arrows do not point toward other yield-generating assets, that is your redesign target. Dalbar's annual quantitative analysis of investor behavior has tracked the gap between market returns and actual investor returns for over 2 decades. The number is consistent and damning. The average equity fund investor underperforms the S&P 500 by approximately 1.7 percentage points annually, not because of fees, not because of bad fund selection, because of behavioral timing errors, buying after momentum and selling into drawdowns. Over a 30-year investment horizon, that 1.7% behavioral drag compounds into approximately 40% less terminal wealth compared to simply holding and doing nothing. That is not a rounding error. That is the difference between retiring at 57 and retiring at 67. The solution is not discipline. Telling yourself to be more disciplined is the behavioral equivalent of a crash diet. The solution is architecture again. Specifically, 3 structural interventions that remove decision points from your process entirely. First, automate all contributions on a fixed schedule tied to payroll, not market conditions. Dollar cost averaging does not maximize returns, but it eliminates the highest cost mistakes. Second, create a 48-hour rule for any portfolio change exceeding 5% of your allocation. Put it in writing somewhere that creates friction. The research on cooling off periods in financial decision-making is consistent. Most reactive trades get abandoned when slowed down. Third, build a written investment policy statement that specifies exactly what conditions justify a change in allocation. Ambiguity is where behavioral errors live. None of this requires sophisticated tools. It requires pre-commitment, deciding in advance what future you is allowed to do. That is the highest value personal finance work you can do this month, and it costs nothing except 2 hours of honest thinking. This is not financial advice. But the data on behavioral drag is one of the most consistently replicated findings in the field. Engineering it out of your process is not optional if you are serious about outcomes. Before the outro, a quick word on tooling. Because the architecture we described in Section 2 only works if your brokerage is not working against you. I have accounts on both Robinhood and Moomoo, and the reason is straightforward. Zero commission trading means every reinvestment actually executes at full value. When you are running a dividend reinvestment plan that fires dozens of small transactions a year, transaction costs used to quietly eat a meaningful percentage of those returns. That friction is gone now. Moomoo in particular has a surprisingly deep research dashboard, real-time data, institutional flow tracking, options analytics that you would have paid a few $100s a month for 5 years ago. Right now, both platforms have sign-up bonuses that are worth taking seriously. Free stocks, extended hours trading, and in Moomoo's case, a competitive APY on cash held in account. Links are in the description. I do not recommend platforms I do not use, and I use both of these. If you are building the passive income architecture we discussed, having your infrastructure set up correctly is the prerequisite for everything else. We open this video by pointing out that the most shared personal finance advice on the internet is about coffee. Having walked through the savings rate inflection point, income architecture, and the behavioral tax, you can see why that framing is not just useless, it is actively distracting. The levers that actually move outcomes are structural, not sacrificial. Now here is the question this video raises that we have not fully answered yet. How do you identify which passive income stream to build first, given your specific income profile and tax situation? That is the next video, and the answer is more counterintuitive than you expect. Subscribe so you catch it.